How we doing? Today is Thursday, April the 3rd, 2025. Just coming to you live to do our Zoom, 7:30 Eastern Standard Time each Thursday. We talk about real estate notes. We talk about seller financing, just different aspects of seller financing and real estate notes. And today we're just going to focus on like the power of compounding interest, seller financing, and an amortization schedule. So let me just pull up a amortization schedule here. So if you do have any questions when you see this, you can post it. We will post this on YouTube as well at Abundant Capital Group YouTube channel. You can go back there and watch the replay. But we just trying to get people, especially in the North Jersey, northern part of the country, um, comfortable with seller financing and real estate notes. Um, so let me log in here. Just gonna bring up the financial calculator. So I'm just gonna be using like round numbers. I was just looking at a property, so maybe I'll use that as an example. It's a multifamily property. Where'd it go? Right here. So this is something that's on the market, is in the East Orange. It's asking 650,000. And you'll see the pictures over here. Still needs some work. I don't know exactly what the property is worth, but I would imagine it's probably worth 750, 800. It is a four family. You know, you can agree with that number or not, but well, actually, let's see. Let's see what this says that it's worth. Doesn't give I think, let's see. Think we can look somewhere else and get an idea of what it's worth. So let's see what Redfin says it's worth. Oh, that's the same site I was on. Let's see if Zillow is saying it's worth about what the asking price is, 660. So let's see what Realtor.com I'm meant to hit. So it's saying that it's worth about 650. So you know, the property does need work, but just for example purposes, we're just going to use these numbers in a for a on the amortization side of things. So in this particular example, like if you own this property, you can look at it two ways. You can say I own it outright. Maybe somebody bought it with cash. They don't have a mortgage on it. You can look at it that way, and then you can also look at it if there was a mortgage on it. So we can look at it both ways. So let's just say at $650,000, if you were to create seller financing on this particular property, um, typically you're looking at anywhere between like a 10 to 20% down payment when you are doing seller financing. The nationwide average is over 20%, but we'll always try to use conservative numbers when we're doing examples. So let's just say we get 15%. So that means that if you seller finance this, somebody would give you as a down payment 97,500. So that would go in your pocket. And a lot of times we try to use this strategy or talk about this strategy because, somebody that, may have equity in this property, like I said, in this case, let's say it's free and clear, obviously it's $650,000 minus, any expenses, realtor expenses, attorney expenses, closing costs, stuff like that. So let's just say, you know, like $600,000. Um, but maybe you don't need a whole $600,000 to go ahead and do something. Maybe you don't have anything pressing need to say, I need $600,000 to go to X, Y, or Z. So what is that money going to do for you? Is it just going to go in a bank? Is it just going to go in some type of account where you're not getting a lot of interest? You may put it in something that's getting 3, 4, 5% interest rate. If you do seller financing, you can get a better earned interest on that money doing seller financing. So you would take the 97,500. A lot of times that will suffice what your immediate need is. And I'm just, using arbitrary numbers. So now you would write the note will be based on 552,500. And what rate will we do that at? When you do seller financing, a lot of times you do it, above what the current rates are. Right now I saw it was about 6.6, 6.7. So let's just say we do this at 7.5%. Again, we can do that because we're offering seller financing. A lot of times the buyers that will use seller financing cannot go to a bank and get that 6.6, 6.7% rate. If they do go to a bank, they may, be getting a higher rate anyway because of, their credit, different situations, different things with them as a borrower may cause their rate to be a little bit higher. So we're probably about 2 points, 1.5 to 2 points higher than the normal rate. And sometimes it goes higher than that, but I would say on average, maybe about 2%. Um, so let's just say we do 7.5. And so now that payment to you, the person that is selling this property who's already collected 97,500 each month, they're going to pay you $3,800, $3,863.16 per month. So that's your monthly payment coming to you for the next 30 years. And so the reason why I do want to show this is because of this amortization schedule. So let's just say in let's say in 2 years something came up in your life as the person who wrote the note. You're the note holder, and let's just say you needed, $200,000 for whatever. Maybe now the opportunity has come up. There's a business opportunity, there's an investment opportunity. There's you want to pay for a child or grandchild's tuition for college or something like that, and you want 200 grand. In 2 years, you're still owed over $540,000. And so what you can do is you could sell this whole note for a certain amount of money. After 2 years, let's just say it's 336 months. So that's the 541. Yeah, we said 529, 529, 529, 620, $529,629.91 is what's due to you, you know, at the time that it gets paid off. Um, so my months must be off. Let's see, 360 minus 24. Minus 24. No, that's right. Okay. So for some reason the balance is a little bit different. I'm not sure why it's doing that. I'm not sure why it's doing that, but the amortization schedule says 529. So you could, let me see what that number is. 529, 629, 91. So they're basically saying after how many months is that? 360 minus 312. So that's actually 4 years. I don't know why it's doing that. That doesn't make sense to me. But either way, it's a significant amount of money that's still owed after 24 months. Um, so let me go back to the 336. So, and what you can do at this particular time is that, like I said, you have two choices. You could sell the entire note here. Somebody may buy this note. They may be looking for maybe a 9%, or let's just say they want 9.5% return. They would pay you $453,485.52, for this note. So they would then make a 9.5% return. You would get this cash. So you would have gotten, let's see, 3,863.16. So you would have got this monthly payment for 24 months. So that's $92,715.84. Plus we got 97,500. And now you're going to get another 453,485 and 52 cents. So you would have gotten a total of $643,701. So actually you're making more than you would by selling the property outright once you actually take away, any fees for selling this particular home. So this is how, amortization, compound interest works in your favor when you do this. And this is only after 2 years. Let's just say, you waited 5 years or 7 years because, you didn't need all of the money. And then you had another option. What you can do is you can sell partial payments. So let's go back to 7.5%. So the balance is 500. It says $541, $541,918.31. So let's just say you wanted to sell like half of those payments, half of 336. I think is what 336 divided by 2. 168. Let's say you wanted to sell exactly half of those payments. You want to sell 168 payments at that same 9.5% interest. So you could sell that to someone for $358,241.34. Now remember, you've collected 97,500. So we'll do those numbers. Let me clear this out. So we've collected payments, 3863.16. Remember, this was after 2 years, so times 24 months. It's over 92,000 plus the 97,500 that we received, plus $358, 358,241 and 34 cents. So at this point, you would have collected about $548,457.18. But the kicker is that you're still owed another 168 payments. So after 2 years and then another 168 payments, that would be a total amount of payments of 168 plus 24, 192. So after the 192nd payment, you would then get this note back and then be able to collect the 3,863 dollars and 16 cents. And what'll probably happen in 168 months, which is how many years? That's like 14 years. So after 14 years, most likely between the time that you sold this partial to someone, probably in that time frame, this person's going to sell this property. And so at that particular time, when you look at the amortization schedule at the 192nd payment, there's still going to be a significant amount owed to you. Let's see, 336. You sold that to 7.5. 336. And we go to the 100. After 192 payments, there's still over $360,000 that you're owed. So then you would have made close to, I think what 548 and 360, that's over $900,000 by selling it this way. And this is what people don't understand about what they could do with their particular properties. And this works whether you have a mortgage on a property or if you don't have a mortgage on the property. We just use this one as free and clear, but the only difference is that if there is a mortgage on the property, at a certain point, if you do, if the person sells the property, that underlying lien will have to get paid off if you've created seller financing, which is called a seller financing wrap, because you're wrapping seller financing around the initial loan that you have. So there'll be two loans on against the property. The bank, wherever you financed it from, has the first. You would be creating a second lien on the property, which is called a wrap note around that financing. So, now if that buyer wants to go ahead and sell the property, they have to pay off that underlying loan as well as the one that you created as well. And that's fine because a lot of times, they live in a property long enough, they built up some equity based on their loan. And so they're entitled to that equity. And then whatever you're entitled to as the note holder, you get as well, minus that first lien. And so a lot of times people just cash out of these properties, I think, in my opinion, too quickly. You should use this strategy to kind of maximize. Again, this is if you do not have a pressing need. Uh, and you may have a pressing need, but the money that you need for whatever you have to do may not be the total amount of your equity. And so if it's not, see if there's a way where you could structure this to get what you need to do whatever it is that you want to do, pay for a wedding, pay for a school, college, pay for books, go on a vacation, whatever it is that you want that money for, try to see if there's a way to figure this out to get you the money that you need to do it. And then be able to use compounding interest and amortization over time to maximize the selling of this particular property. And I think more of us, should at least look into this as, as an option. Look at both options. If we sell it outright, what are we going to pay in taxes on the money that we get, as opposed to if we do this, there's some tax deferment that can happen with this particular strategy and reduce, the burden on, the tax burden, as opposed to paying a tax on 650,000, you're only paying a tax on that 97,500 that you received, and then going on from year to year, you pay taxes on the money that you receive, on the income from the property that you receive, and then obviously there's ways that you can reduce that, um, and your tax professional can help you with that, so you can reduce that tax liability from 650,000 to a considerably less, over time as well. So, that's what we wanted to talk about today. I'm going to stop the share. But, we have to, I would say that it's a good idea. If you're a realtor, if you see this, you may want to discuss it, with your clients and kind of make it a part of your business. Um, and then also, if you are going to take all of the money when you sell a property, what are you going to then use it for? There's a lot of opportunity out there, in real estate to use that money, that equity that you're getting to put into, if not one deal, multiple deals, especially when it comes to real estate notes. If you're going to take um, the equity, um, if you took the full equity, and this, let's just say there was a lien on the property and it was only like $150,000 equity. With $150,000 of the equity, you could take that money and buy multiple notes in different parts of the country where, homes are not as expensive as they are here in the Northeast. You probably can buy, 4 or 5 notes with 400 and, with $150,000. And what's that? When you have 4 or 5 properties bringing in 3, 4, $500 a month, what is that doing to your expenses? What is that? How's that adding to, I mean, not your expenses, but your income? You could get a nice extra, $2,000, $2,500 per month to go towards your expenses because now that money is in a note. And, if that, when that particularly when that note that you purchased, at a certain point may pay off again, you're going to get a lump sum at that particular time as well. So again, that compounding interest on the money is happening during that time. So, um, just something for people to think about. I know this is the spring season that we're in and the selling season, but we need to look at some of these situations differently and just compare based on what you have going on in your life, your situation. Only you know that. But, if there's a certain amount of money that we can get you, right now, and then allow the rest of that equity that you have in the property to compound and gain interest over time, why not take that option? All right. So if you have any questions or anything like that, you can, my number and everything, my information will be attached to the video. If you want to watch the replay, go to Abundant Capital Group on YouTube. It'll be posted there as well. And we'll be back next Thursday, 7:30 p.m. If you see this and have questions, please post them. We'll try to get them answered. If you want to, if there's a topic or something within real estate or a question about notes, maybe start, looking into it and, you have a question, you can meet me back here Thursday at 7:30 p.m. or you can post it, any comments and then we'll get that answer for you. Great strategy, great time to do it, with everything that's going on, stock market. We don't know what's going to happen with that right now. It has some issues. Um, so you may want to diversify and look at these opportunities and create home ownership opportunities for people. Create a way that you can maximize the money that you're making on a property as well at the same time. All right. I will talk to you soon. Have a great day.